if you're a risk manager and you're looking at your overall, your portfolio managers and how they're managing their portfolios today, you like those triple Bs because you're getting a little bit of a nicer yield. The spread is, let's call it 200 bips over treasuries. So you like that, and you like the fact that it's been a steady market for the last little while. But gosh, you got to be asking yourself, especially with certain names, that are on the risk spectrum that don't look so great. Maybe they're on risk negative watch. Maybe they haven't hit it yet, but you think it could go there. If you could buy some short-term protection and not cannibalize that yield too much, so it's not hurting you too bad, but you're still getting a big lift over treasuries, and you don't have to sell the thing, so you're not going to take a loss. Gosh, if you're a risk manager, I almost think that you would mandate this product and buying this type of protection to your portfolio managers.
Hello, ladies and gentlemen, and welcome to our interview with Patrick Wood. Patrick is a CEO of DelphX Capital Markets, or DCM. Patrick has over 25 years of expertise in capital markets and is leading innovation in credit risk management with DCM's flagship product, credit rating securities. Today we will discuss about this, but first of all, Patrick, welcome to our Risk Management Show podcast today.
Thanks, Boris. Thank you for having me.
Absolutely. So I believe that we'll have a very thoughtful conversation on the topic of what happens in credit risk management, specifically for insurance industry, your vision for this year, about the bond markets next chapter, and about your kind of idea and solutions for how to improve this market. But before that, Patrick, could you tell us a short story about yourself, your career path, and what brought you to where you are right now, and perhaps what you guys at DSM are up to these days?
Sure, yeah. So my background is in capital markets, primarily in Canada and in the US. I guess, when did I come into the business? Gosh, Boris, it was about early 90s that I came into the business. And so I think I've worn pretty much every hat you can wear in this business: investment banking, stockbroker at one point, bond management, CEO, like I said, investment banking, institutional sales, pretty much every hat you can wear in capital markets I've worn over the years. And one of the models that we had back in the day was taking companies in the US public in Canada. And it's a model that still works. Canada has a great way to list public companies and support them, especially smaller, high growth companies. And in 2018, DelphX was one of the companies that we took public up in Canada through my old company, which was an investment bank in Canada at the time. And DelphX flopped. It had a very, very tricky, discombobulated product, which really just didn't work at all. Certainly wasn't accepted by Wall Street. And very reluctantly, I came in as CEO of the company to really kind of clean the deck, see if the company had anything worthwhile that we could advance through the market. And if we did, then move the company forward. And we're very thankful and blessed to have some very great shareholders supporting our company, and they've stuck with us all along, which is super. But that being said, we tore the companies, kind of their IP apart, and there really wasn't anything there. So we said at the time, look, we've got a great public company shell. There's a couple of small little things that have been created which make a bit of sense, and with the help of external advisors, professionals on Wall Street, people who have had great experience in structured product markets, as well as feedback from the insurance community in the US, as well as hedge funds and others. Really, we absorbed all the pain points that everyone had really suffered and said, is there something we can create as a company that hasn't been addressed and hasn't, there's a need, but it hasn't been an addressed need yet. And that was the genesis of the credit rating security. So, 4.5 years later, we're now rolling out the credit rating security, where we'll actually have transactions, we believe, in the first quarter of this year. So in the next month and a half. And so like I said, it's a real turning point for our company, which is a publicly traded company up in Canada and in the US. So like I said, being in this position now, where we've spent so much time, so many man hours and capital, and invested, kind of capital building this, we really think we're going to have, America's next great structured product. And it's time that America actually does have a new structured product, because in the last decade plus, Wall Street hasn't innovated a single thing in the credit markets. So this is really a turning point, not just for our company, but it's also a turning point for US capital markets in a sense. Because, like I said, the credit markets haven't invented anything new. And to be quite frank, Wall Street's been asleep to their customers' needs. And so, the lack of innovation, the lack of kind of real chutzpah to get this thing going and get new products going doesn't exist anymore. So, like I said, it's created an entry point for this small little company to come in and do something new and really fix something that needs to be fixed a bit and present guys, like I said, with new opportunities that don't exist.
All right, fantastic introduction. So,
Yeah, how's
so
that?
let's
How's that?
discuss. Absolutely.
That's my
So,
intro. There you go. Yeah, but I
so
could dig
yeah,
into credit rating securities a bit. Yeah. Why don't we
yeah,
why
yeah.
don't we talk about credit rating securities? I think that's probably a good place to go. And so credit rating securities, they are essentially they're a painkiller. They're a painkiller for bond managers in the insurance industry, and our starting point is in the U.S. So we're talking, what is it, a 10 trillion, $15 trillion US corporate bond market, publicly traded bonds. And so if you're an insurance manager in the US and you run a triple B bond or you hold one in your portfolio, one of the big pain points for that insurance manager is like, heck, if that bond gets downgraded, the NAIC, which is my regulator, the National Association of Insurance Commissioners, I believe, but the NAIC, they have these things called capital charges, and whenever the value of my portfolio, kind of disintegrates or it lowers, for example, a triple B bond turning into a double B bond, hence going from investment grade to high yield slash junk status. The only way I could really protect myself is I could sell the bond. But generally, if it's already a triple B, I'm already, kind of, I'm sucking wind in the sense that my bond has already lost value. So I'm going to have essentially, I'm going to have a loss on my books if I sell it. I don't like that because I like the name. But, the other thing I could do is I could buy a credit default swap. Credit default
Mm,
swaps, they are a real pain for downgrade risk. Default risk, they're great, but downgrade risk, forget about it. Because spreads, can do very, very strange things when bonds get downgraded. And credit default swaps, once again, you're dealing with a lot of characteristics to a CDS that just, that won't really give you the coverage that you want as an insurance manager if and when those capital charges go up. So, for example, if you have a triple B bond, your capital charge is about 1.5%. And if it goes to, double B plus, a couple notches down, that capital charge goes to 3.15. So you're dealing with
oh,
about 1.5% more in capital reserves you have to have allocated. But get this, they actually mark that 4 times up. So generally, the rule of thumb within the insurance company itself is they're actually taking more like 6% and allocating it toward that kind of capital reserve that they have to have. That's 6% of their funds that they could be investing in other things. So they are loath to kind of, once again, hold that bond. Once again, they don't want to sell the bond because they've already got a loss, and they generally like the name longer term. And insurance companies are notorious for essentially, holding bonds, buying and hold till they mature, which is a smart decision. I mean, if you like the name, so for example, think about who's been in the news lately, Boeing. And I hate to pick on Boeing, but
mm-hmm.
they're there, and then the planes keep falling out of the sky, and the doors keep blowing off the planes, and all the rest of it. But Boeing has done a terrible job as a bond. Their bond values continue to deteriorate,
Don't, yeah.
and I mean, Boeing is a huge holding in the U.S. You're talking, hundreds of billions in bonds. Um, Actually, so there are not hundreds of billions, but let's call it billions in Boeing bonds out there. And so, if you own a Boeing bond and you're an insurance manager, your capital charges keep climbing up. Now, if you have a 5 to 7 year Boeing bond, you're comfortable with the name. Boeing isn't going anywhere. Those bonds will be made whole at the end of the day. But if you sell that bond now at a discount, gosh, you're taking a capital loss. You don't like that. That looks terrible on your books. But to get through this turbulent period, should that bond continue to get downgraded, our product, the credit rating security, gives you a cushion such that if those capital charges move up, you're going to be covered for those capital charges, whatever the increase is. And on the other side of the equation, we have a hedge fund who is essentially selling that protection. The hedge funds love this product because over a vast array of bonds, generally, they're doing quite well because they're capturing a premium which the insurance company pays for the protection. They're capturing that premium, and like I said, they're doing other things with that. So it's a fully collateralized portfolio as well. So the insurance company with our custodian U.S. bank, they put those collateral reserves in treasuries. They're held there in treasuries until the actual structure is expired or matures. We're the guys in the middle as the issuer, issuing both of these new securities, and these are for A2 securities in the United States. So think about private placement securities for qualified institutional buyers. So insurance companies, hedge fund banks, fund managers, etc. So, like I said, we've created a painkiller for a need which wasn't there before, and is by virtue of Wall Street being asleep for the last many years, not invading any new real products. And really not listening to what their client needs are. Because when we talk with insurance companies today in the US, one of the things we continuously hear is, where has this product been all along? Why
Yeah.
hasn't Wall Street developed it? And let's face it, Wall Street doesn't have the bandwidth or the creativity that it used to have. We want to bring that back to the bond markets, and
Okay,
we think that we're one of
fantastic.
the few companies that are kind of doing that at this stage. So it's an exciting place for us to be.
Yeah.
So
Yeah, I remember Lehman Brothers. Some people made a lot of money on CDS bonds during this crisis, and that what would happen to when if there was a product like yours available in the market during the crisis?
So that's a good question. CDS CDS was first kind of, I remember when it came out in 1994, it was JP Morgan who created CDS, credit default swaps. Credit default swaps, and it was a big team at JP Morgan who developed this. And so JP Morgan was able to get credit default swaps moving. But at the time, there was great reluctance on the street. You ask any guy on a desk, on a bond desk, what did you think of CDS? They all just thought, like, what am I going to use this thing for? I mean, this is such a sleeper product. You're dealing with ISDA, you're dealing with an auction, you're dealing with recovery values, which are unknown. There's no need for me to do that. Well, advance 10 years after that, and you had a lot of people who recognized that the market was doing great at the time. So you had Lehman, AIG, all these goons essentially underwriting credit default swaps where they had no collateral behind that underwriting. And so lo and behold, you ended up with something like 40 to 50 trillion dollars in notional credit default swap value out there, which eclipses the size of the bond market. And you had a bunch of other instruments created alongside that, CLN, CDOs, other stuff, which really leveraged the heck out of that. So it
Exactly.
was a
Yeah.
great windfall for the street. But when things went bad, that's when CDS really, it actually did okay for some people where the collateral was there. But if you had the wrong underwriter, your CDS was worth nothing. And so CDS had purpose. It was abused. But then you ended up with Volcker, Dodd-Frank, and other things kick in, which were supposed to, kind of eliminate that amount of leverage in CDS, which I think it has. But we're in a state right now where CDS, like I said, should have been there to protect people, but it was abused. So CDS didn't help people. Had our product been around at the time and had those bonds get downgraded, which they eventually did, everyone would have been made whole, because we're a fully collateralized security. So whatever that capital charge increase was, you would have been covered on it because your collateral was a U.S. Treasury, and a fully collateralized instrument. So there's no way for malfeasance or other shenanigans to happen with our product because you've got a fully collateralized security on both sides. Which, like I said, that CDS event was a one kind of a one-time thing. But once again, CDS is looking at defaults. We're beating the market to the punch in the sense that we're looking at downgrades, which generally happen a lot sooner than a default. Unless you're looking at a WorldCom or an Enron or something like that.
Yeah.
and you go straight down. But even then, our instrument, you're sure getting, you're sure getting those capital charges paid to you, which is important. So
Absolutely, that's very interesting. When I was 20 years ago, when I was used to be a risk manager at the bank, I studied all this product, but I think it was actually we missed such product as you for credit risk. So I wonder why nobody came
sure.
uh,
Yeah, yeah, yeah.
to.
And just think about that. If you were a risk manager, think about it. You're a risk manager right now at an insurance company in America. And you got a lot of headwinds in the market that are, some people can see, some can't. You've got a lot of tariff talk, which is freaking guys out. You have a lot of company specific risk right now because rates have gone up so much. So companies refinancing debt from, a few years ago. It all, all these things put a dent in income statements and balance sheets to a degree. And there's there hasn't really been a market shock since COVID, but that was a real short-term shock. It happened overnight and then it was fixed. Well, it wasn't fixed, but they pumped in, trillions of dollars of money into the market. But that being said, if you're a risk manager and you're looking at your overall, your portfolio managers and how they're managing their portfolios today, you like those triple Bs because you're getting a little bit of a nicer yield. The spread is, let's call it 200 bips over, over treasuries. So you like that, and you like the fact that it's been a steady market for the last little while. But gosh, you got to be asking yourself, especially with certain names, that are on the risk spectrum that don't look so great. Maybe they're on risk negative watch. Maybe they haven't hit it yet, but you think it could go there. If you could buy some short-term protection and not cannibalize that yield too much, so it's not hurting you too bad, but you're still getting a big lift over treasuries, and you don't have to sell the thing, so you're not going to take a loss. Gosh, if you're a risk manager, I almost think that you would mandate this product, and buying this type of protection to your portfolio managers, because portfolio managers can also be somewhat brazen, and they can be, caught without bandwidth, without properly monitoring their portfolios. But as a risk manager, if and you and your senior committee can kind of see something that would buffer you and continuously uphold your fiduciary duty to your policyholders, etc. If you could do that, I mean, you would say to these guys like, look, at least half of your triple Bs should have some protection on them. And so if you think about that, about 3 trillion or more triple B paper is held by insurance companies in the US. For us as a small company, that's a massive amount of business. To get even a small portion of that. So for us, that makes us very excited because we're in this to make money, and succeed on that front. But at the same time, we're creating a tool which could really buffer insurance companies and really protect them and mitigate some of those risks that come, inherently with owning a triple B bond. So
Mm. So it's kind of a sort of put option if you compare it with market
sure, yeah.
risk.
It's exactly what it
Yeah.
is, man. Yeah. And thank you for asking. I didn't really share how the product exactly works, but yeah. So what we do is we issue two new securities at genesis of a trade, or let's call it a transaction. On one side, you have the insurance company buying what we call a collateralized put option. On the other side, funding that CPO, or the amount of risk on that CPO, or collateralized put obligation, is a collateralized reference note. And the collateralized reference note is a fully collateralized note, which is held in US Treasuries, which basically funds the put option should there be an increase in capital charges, and should there be that downgrade. So, for example, if you own 100, let's call it 100 million of notional bond value, and let's call it Boeing today. Let's say Boeing's at triple B minus, and so as an insurance company, you're thinking, gosh, okay, my capital charge right now is 2%. It's going to go up to 3% or three, a little over three if this thing gets downgraded to double B plus. For the next 13, let's call it 14 months, I'm gonna pay, let's say I'll pay, you know, 20 bips in protection, on essentially guaranteeing me that 1% should this thing get downgraded. So it will cover my increase in capital charge to double B plus. And on the other side, the hedge fund has said, okay, we'll put up that full 1%, fully collateralized. It's held in the U.S. Treasury until this thing expires or matures. And like I said, that is how we create these things. So you end up with two new securities, abbreviated as a CPO and a CRN, both credit rating securities. But like I said, they're kind of intertwined with each other, completely interrelated in the fact that one has paid for protection, the other one has actually collateralized and funded that protection. And so you end up with basically two tradable securities, which can be exchanged. They can be, sent, or traded to others. Sorry. Um, but you end up with something, like I said, that is pretty rock solid in the sense that there's zero, unless U.S. Treasuries bust, which, if that happens, we're all living in caves anyway. But if that happened, so anyway, long story short, you've got zero risk in this on either side, in the sense that you've got a fully collateralized security, and most importantly, you know we're in the middle as the issuer, operating as strictly the issuer of these two new securities.
Mm.
And so cash flows are managed by U.S. Bank, will also act as our calculation agent. The collateralized reference note is a DTC eligible security, so that's fantastic too. So to change that thing, to move it around is pretty easy to do. Yeah, that's kind of it. So I mean, I got to ask you, Boris, does that make sense what I said as far as how these things are
Yeah,
done?
yeah.
Yeah,
Also, I
okay.
have
It's
some
it's simple.
basic understanding, but
Yeah, it's
for
it's
me.
it's super simple. Yeah, just imagine one guy buying risk, one guy funding the risk, and we're in the middle as the issuer, and U.S. banks at the bottom. They're managing all those cash flows, so we don't touch any cash. We just clip a fee. So we charge each
Mm,
side generally $50,000. We pay the custodial charges as the issuer, and we're a Delaware LLC. But anyway,
mm,
like I said, you've got two very simple securities: buying risk, funding that risk. This guy pays this guy, let's call it $1 million to fund that risk. This guy saying, I'm going to put 4 million here in case those capital charges go down to that set level, that agreed upon
mm.
level.
And
Um,
who
and and
who
and
decides, for example, if they want to trade in the specific security? So companies that hold this bond, right? For example, they hold the
yeah,
Boeing, they will want to take a protection, right?
that's it, man. 100%. From capital charges, not the loss on the bond. Because what's interesting, sometimes a bond gets downgraded and the value of the bond or the spread actually tightens. It's the strangest thing. So they're not buying protection necessarily on the drop in value of the bond. It's specific to that capital charge.
Capital
And so
charge.
that's why this is curated specifically to American insurance companies. Once again, it addresses that pain point, which is created by a deterioration in value of their bonds, which is regulated, like I said, by the NAIC.
All right.
So
Yeah, very,
yeah,
very interesting. Thank you for the explanation. So, what is your kind of vision for the future of credit risk management and evolution of structured finance solution in our age of maybe AI or something important
sure,
that
yeah,
we
yeah,
can?
that's a great question. I think AI is making a big impact on things as far as price discovery and values. I think AI is limited in the fact that this is still a very people-centric business, in the sense that you look at the rating agencies like S&P and Moody's, and Fitch. These are still people running things now. Are they using AI models to predictively analyze and kind of put things on watch and downgrade, et cetera? Probably they are to some degree, but it's still a very people business. I think the management of risk in general, I think people can make mistakes, but I think we have a greater risk of machines making mistakes in this type of a situation. And so I think what happens is you end up with more tools like ours coming from companies that are like ours, that kind of see a window within Wall Street to kind of make an impact and make a positive impact. And this is, once again, this is, let's call it, small company innovation, creativity, and bandwidth to do something like this. So, like I said, I think, and I hope, that on Wall Street at least, that there's more of an acceptance to risk management, not just as a kind of management tool for for insurance companies, but I hope it's more of a become something that's more traded again, because trading on Wall Street, specifically in credit markets, is dead. I mean, there's very little action there. You go to a bond desk in New York today, or anywhere for that fact. I mean, mind you, I can't speak for Paris because I know that Paris still has a really active bond thing, but I mean, I know that it's just a sleepy town. It's very, very quiet. ETFs, indexes, etc., have really kind of cannibalized the business. Everyone thinks that's great. To some degree, I think it is. But in the meantime, though, you still have institutions holding individual bonds. They're going to continue to do that. And I think that's where, because, everyone's still seeking alpha wherever they kind of can, even if it's like, a fraction of a basis point, insurance managers will do that. And I think for that fact, like I said, I think there's new product innovation. I think that the market itself will continuously have shock moments, et cetera. We haven't had one for ages, so we're kind of due something. But in general, though, like I said, I think there's more innovation that comes out of companies like ours making an impact, and hopefully following suit and doing stuff like we're doing. So.
All right, fantastic. So, if we summarize our interview for someone who is listening and would like to walk away with one or two major takeaways, what would that be?
Um, so if you're a risk manager at an insurance company, look at our product. You have to, because your competitors and your peers are starting to use our product. Two, I think if you are looking for a great investment, I think DelphX Capital Markets could be a really great investment for a lot of people. Like I said, we're publicly traded. We have a website, delphx.com, delphx.com. It's a silly name, DelphX. Trust me, it's not the one that we wanted, but that's why we've really changed it to DCM, which is our
Mm.
preferred banner. But either way, we're stuck with the name for now, at least. And anyway, I think people should definitely kind of consider both of those things, because I think, like I said, addressing that pain point of capital charges is really, really important. Because it hasn't been around, you just haven't had a way to do it before. So we're bringing you that option. On the other side, like I said, small little growth company stock, looking to change the way that Wall Street operates in credit markets a bit. Could be kind of interesting. Like I said, we like the stock. We think it's going to do great. We've been great supporters of it, and yeah, and I would say, as well. I mean, people should be thinking about risk right now, because they have not been thinking about risk for some time.